that was about the nicest introduction I could ever imagine. Thanks, Eric. And just so you know, I'm wearing this specifically because I wore this at the Maze Out for Penn State, and I figured that brought us luck, so maybe this will bring me luck today. So, notwithstanding all the, the nice stuff Eric said about me, the journey has not been easy all the time. And so I'm going to share a little bit of my journey, and hopefully this will provide you some insights into, notwithstanding what the veneer looks like, how the sausage is made can often be a lot more complicated and a lot more challenging. So when asked to use this framework, what I immediately thought of was kind of departing my kind of cushy journey on Wall Street and going out on my own and being an entrepreneur. And for me, it was really a function of when I felt that the learning had stopped. I've always been somebody who is easily bored and would always want more, and that was a great attribute in kind of the hurly-burly world of Wall Street, navigating from M&A to sales and trading to quantitative trading, derivatives. But there was a point when kind of the learning curve really plateaued and the politics became so oppressive that I really wanted to do something different, and I wasn't having fun anymore. But I left, and I really had no idea what I wanted to do. It was not like I had this great plan. I'd love to say, oh, I want to start my own firm. I want to go into a PE. I literally just left, and I had a couple of young kids. My life partner that Eric had mentioned, I met her here in my undergrad years, and she was super supportive, and it was just like, figure it out. I had started being an angel, but not like with great intention. I had collided with a few companies through people that had gone to graduate school with somebody and said, oh, you should meet my boss, Roger. He's technical in his money. He's a good business builder. You should talk to him. And then made a few investments. And when I had the time and the space to really spend time with these founders, I discovered that I absolutely loved working with these young teams, and that while certainly they knew infinitely more about their startup than I did, the business building skills and some of the interpersonal dynamics that I had kind of honed in my 20 years on the street were very, very helpful in that context. So I decided, okay, I'm going to go all in on this. And this happened very quickly. My wife, Karen, was like, oh, why don't you take a year off and write, and you said you want to go back to school and this, and that lasted about 3 days, and I was just so antsy that I ended up really throwing myself into this new life. It was kind of crazy. Like my colleagues at work, some of my close friends who kind of had a sense of my kind of economics and level of success, like nobody does that. It was super easy for me to just keep making money, but I really was not having fun and was not going to optimize for just clipping coupons as at that point, 38-year-old professional who had this great rise but really felt like I was stuck. At the same time, living in New York City, so when I graduated from here, went to Wall Street in '87, my wife graduated in '88, so we were in New York. Raising 2 kids in the city is expensive. And we had found these amazing progressive schools that we really wanted to send them to. And so, yeah, the very stark reality of supporting my family while not working was, and then just basically hemorrhaging cash, as I was not only supporting our life, but at the same time investing in new businesses, at times was a little bit scary. And of course, genius timing. So when I left here in '87, for those of you who have an appreciation for the financial markets, I started mergers and acquisitions in August of '87. That was right before the great crash of '87. And then I leave my job and I'm investing money in startups, and what happens? The global financial crisis. Yes. So I'm shitting. I am really worried because I have no idea what the timelines on realizations on these highly liquid investments, what it's going to look like. I'm still have a high burn rate. I mean, I've managed the life burn to be as low as possible, but I'm still investing in new businesses and following on in rounds. I'm acting like a VC, but with my own money at a time when my balance sheet is just shrinking, 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 and nobody knew what was going to happen in the wake of the GFC. So I was really questioning, whether or not I should go back to the street and just go back to clipping coupons, but reducing my risk profile. And my wife said to me, do not do that. And this is why she's the greatest person in the world. She's like, you made a plan, it's a great plan, you always told me, even when it's hard, volatility, you've got to ride it out. Like, the time value is critical. And she said, and even if it doesn't work out, we'll sell everything, send our kids to public school, move to the suburbs. Like, we've never wanted for more than that anyway. Neither of us grew up with money. This was all like, whatever. So she gave me the strength and the support to just keep going. But one thing that I really didn't know at the time, but has actually been true in the subsequent 14 years since I had this reckoning, is that I have the ability to this day to relate to founders in a way that I couldn't have imagined, because I felt that pain of sleepless nights, looking at myself in the mirror and wondering, what am I going to do? And it's insanely uncomfortable. But being very in touch with that feeling has really, I think, helped me be a way better mentor, advisor, and support to my founders over the past 14 years. In the midst of all this, so I'm investing in companies, I meet a founder, a serial entrepreneur who had built some very successful companies, who had this idea for a new company that was really right up my alley. It was a financial technology company called Monitor 110. And so we ended up partnering. So as I'm being a professional angel investor, I also joined the startup, so I co-founded a company. And this company became scorching hot. Like, we were actually on the front page of the Financial Times, raised money from top institutional investors, and I will tell you, knowing what I know now, I didn't know shit about building a company, like nothing. And again, I had been so successful on Wall Street and had built and run multi-billion-dollar businesses. It's totally different when you have all of this infrastructure and all of this scaffolding behind you, that sure, I can recruit well, I can motivate and incentivize well and lead well. But building a company from the ground up, I'd never done it, and I ceded too much control to my partner, and ultimately, we failed. And it was painful because I'd never really failed like that before. But the amount that I learned from that failure was, it really changed the course of my life. I actually wrote what's arguably the first post-mortem in the wake of a failure in tech venture capital. You can look it up, it's on Google. It's called Monitor 110, a post-mortem. And it's been read hundreds of thousands of times and served as an early example for kind of, I think, how to fail with introspection and dignity. And the writing of that post really, if I look at the elements today as somebody who's now a successful venture capitalist, it's like I had these insights in 2008 that honestly I used and refined ever since, even when building an institutional venture capital firm. And the same mistakes I made then, I'm on the lookout for and advise founders against to this day. Again, it's like the timing could not have been worse. Just everything coming to a head. This business failing, global financial crisis, hemorrhaging cash. It's like, give me strength. But I kept going, keeping the head down and letting good decisions and risk tolerance and time take hold. When we came out of the GFC and kind of the tide went out, what you saw was I'd invested in a bunch of really good companies, and I started to get some exits of significant consequence, and not just economically, but from a brand value perspective. And so I started to become known as one of the best early stage investors on the East Coast. And at the same time, I also had this thesis around big data as an investable theme, which was not kind of the hackneyed term that it is today. Back in 2009, big data as such wasn't really a thing. Now, it had been a thing for me, because in quantitative trading on Wall Street, big data was everything. And of course, kind of the innovations in big data analysis and infrastructure would really happen very much on Wall Street and in the defense sector. That was not a common insight. So when I decided to start a firm around this notion, again, coming out of the global financial crisis, people liked the story, but most institutional LPs were still not backing, and emerging managers really wasn't a thing then either. So I felt like I was right, like I was onto something here. So I kind of brute forced a first close with people that had known me and trusted me from my prior life on Wall Street. And then I put in a bunch of my own money to get the flywheel going so we could start making investments and get in business and kind of do what I said we were going to do, which is to start the seed stage firm based in New York, not the Valley, which was going to lead seed rounds, have significant ownership, but all with this consistent theme. It ended up that it worked. The first 6-9 months of 2010, a bunch of the companies that we had seeded, where I'd met the founders in 2009, but started funding them in early 2010, started to really develop profile. Emerging managers became a thing, and big data became scorching hot. So I had originally sought to raise $25 million. I got in business on $17 million, but kept the fund open during 2010. And then we had $85 million of institutional demand in Q3, and we ended up closing the fund at 50. And then we were kind of off to the races. So in any event, if you were to ask me, could you ever have imagined that you would be a venture capitalist, much less a successful venture capitalist, given where I started, I would have said, what's a venture capitalist? Much less, or am I going to be successful or not? So I guess I find this kind of constant inquiry and questioning and trying to figure out the intersection of your skills and your passions, like, is what you're doing what you want to do? Or are you just there because it's comfortable? Like, I think constructive discomfort is a really positive thing. And that's something that I apply in my day-to-day life today, just being extremely honest with myself, tapping into my internal state about, is what I'm doing today what I want to be doing? So this is a bonus slide. So I recently kind of taught a pilot class in Ross around venture capital. And this was a slide that I had in there. And I think it's just really important when thinking about the world of venture capital and whether or not you want to be an investor. It seems glamorous and it seems super cool, and it's certainly very cool in many aspects. It is a really, really, really hard job if you're doing it right. And what I mean by that is that you're investing in people, you're acknowledging that you're investing in people and their dreams, and that you're effectively taking on part of that burden by investing in them and empowering them. And it's complicated, especially if you're investing in the early days when a company is pre-product market fit or has a very young product, because there are so many decisions, and how you structure the experiments to determine if there's product market fit, that fear of failure, that desire to not experience the pain of negative customer input, but where that's actually what you should be getting. So it's not a normal job, and it's the least 9-to-5 job you could ever imagine. It is all-encompassing. I've gotten calls from founders halfway across the world in the middle of the night, and I wanted them to make that call, because if they're feeling in crisis, if they're feeling scared, concerned, if they've got a conflict with a co-founder, They're concerned about a client engagement. Whatever it is, if you are backing them and you are, in my opinion, a good investor, which means being a good person, it is insanely hard. So kind of acknowledging that and being able to draw some lines between where your work ends and the rest of your life begins, it can get very muddy. So again, I think it's just a useful frame. To me, there's no more satisfying job in the world than helping empower and inspire brilliant people towards bold visions. And when it works, there is no high higher than seeing the people that you've supported be successful. And it's really way more their success than your success. It's their company, not your company. But the process of getting there is never, not seldom, never linear. It is never up and to the right. There's a whole bunch of stuff that happens from here to there. That's it.
All right. Well, thank you for that. Appreciate the education. Jumping back to what you were talking about with being empowered, feeling fulfilled, feeling the gratification of helping people and helping those teams grow, break it down for us. What core characteristics make for a successful founder or an investable founder?
So we like to have this saying, my partners at IA, it's kind of a non-negotiable vision and a series of highly negotiable missions. So what that means to us are founders who have incredible clarity on the kind of company they want to build and the kind of impact they want to have. And they're going to get there come hell or high water. At the same time, they are not dogmatic. They are very pragmatic, and they understand that when you are building a product and you then collide with the market, that the market may have something to say about, that path that you laid out, no, go back and try again. So somebody who can have that unwavering knowledge of the future they want to build, but is flexible enough to adapt to market circumstances is the balance that we're looking for. It's really, really hard because so many, if you have that level of passion and focus, it also tends to be that some of the best founders are opinionated in a way that can make it hard to hear constructive input. I think we've been very fortunate at IA to have backed founders who had that kind of unassailable vision of the future, but where they really wanted to be their best and could listen to input and feedback.
Conversely, when we're thinking about investments, it's of course the founder, but there's also the technology, the product, the company. You talked in a podcast this past spring about your biggest investment mistake in hindsight and chasing 2 checks into a company. Mind regaling that story? Yes.
Sure. So great technology and compelling founders can often be blinding. And when you meet somebody or a team who is just so competent and so impressive in talking about the application of their technology, that you can lose sight of the market piece of it. And the truism is, you always need to be backing A founders, but if you back A founders into a B market opportunity, then the ceiling is a B outcome. Now, if you have a B founder with an A market opportunity, you might get a C outcome because B founders don't recruit A people ever. So you need both. And in that specific case, I think I over-rotated on the technological competence of the team and really wasn't critical enough about they ended up having incredible customer concentration. so that when they lost a deal, it was like a very significant share of the TAM in the way that the market was at that point. And so it ended up, we sold it for pieces, and I think maybe got like, I don't know, 50 cents on the dollar back. But that was, I should not have written that second check. I knew after the first check, I just over-rotated on their ability to be able to create a market that just was not ready.
You talked too about how founders, the advice that you often give to them is the idea of keeping your head down, ignoring the noise. To students who are coming into a world where they're constantly bombarded with distraction and noise, what are the techniques you deploy or you suggest to founders to deploy to keep that focus?
So something that we kind of have our founders do, we actually work on it in conjunction with them before we write our first check, is kind of what we call the hypothesis document, and where we basically work with the founders to try and identify, what are the 2 to 3 key questions that you want to answer with our money as you're reaching for product market fit. And those, you can think of those hypotheses, the questions, hypotheses, secrets that you think you know that others don't know or don't believe, and then figuring out, well, what are the objective measures and metrics that would serve to validate or invalidate that hypothesis. So it creates a structure around and an intention around how they are going to spend their time over the ensuing 12 to 18 months. I would argue, I do the same thing for myself in my own work life, where I write things down a lot. I use structured hierarchy of lists a lot to help me allocate my time and block out the noise. And the ability to say no is a superpower. And I think if you can learn that at your ages and stages, it will serve you incredibly well. Now, there's saying no in a kind way, but no. And it's okay for somebody to be unhappy or frustrated or disappointed. That's fine. Ultimately, there is nothing more valuable than your time and attention, and distracted attention is a killer. That's what you want to avoid.
As you're looking and running those intake litmus tests of sort with the founders that are coming in, and now as you're moving with Ehrenberg Capital into the Web3 world, break down for the students who aren't familiar with Web3, what it is that we're talking about, and what those 12 to 18 month kind of timelines should be measuring, what they should be looking at for Web3 founders. What is it that you're looking to see them articulate?
I almost think we're conflating a few things with that question. I don't really see Web3 as a thing. I see it as a form of infrastructure and a set of enabling technologies, and that's it. Like, I'm not at all entranced by the notion of crypto or tokens or whatever some people think of Web3 as being. We're really focused on, and also we do a lot of stuff in the gaming realm that may or may not touch Web3. But in terms of our Web3 investments, they're very much either infrastructure or they are very specific applications that, because of the architecture, does something better and differently than Web 2. So, and this is the exact same thing that we did at IA, separate from Web 3. This is like when we were in Web 2 and saying, well, this new thing, or the cloud is a great example. Is this new distributed technology better than what we have today? And it can't be hand-wavy. It needs to be, why is this better? We ask those same exact questions of Web3 companies today. Is what they're purporting to do something that you cannot do with Web3, or with Web 2? Is there something inherently better in the delivery of a product to a customer that cannot be gotten with existing infrastructure that can only be unlocked by Web 3? And I would say that, probably one area that we've spent a bunch of time in, where I'm convinced that that's true, is in loyalty. So the notion of
Like brand loyalty?
Brand loyalty. So, being able to use NFTs and other forms of stored value and engagement for customers that extend beyond traditional Web 2 offers, coupons, things like that. So in any event, then it's like, well, okay, do we look at those companies any differently than we might a non-Web 3 company? The answer is absolutely not. The kinds of hypotheses and questions that we would want founders to construct in this pre-product market fit phase, identical to what we've done with all of our IA Ventures companies. It's the same process.
So, I mean, whether we're talking about you coming off Wall Street and then going into VC, looking past the GFC to be capable of seeing what the opportunity was to dive deep at a time when others were pulling back, or now Web3, it seems like you've got an ability or at least a distinct intention to look beyond the horizon and kind of see what's out there and what's going to be next. You've taken that also to your personal life, and you've recently talked about how you and your wife Karen are invested in Michigan, not just the university, the state, the city of Detroit, that you believe that this is a bellwether of all aspects of change that are going to happen across the country. Talk to us about why that is, and what students should be thinking about that they might be in a unique advantage and in a position to participate in by being here.
So first off, something that kind of underpins everything that Eric said in the way that I look at the world is I see time horizon and risk tolerance as superpowers. And I am able and willing to withstand extreme amounts of volatility and pain while waiting for a thesis to play out. So, and let me just tell you, I do believe it's a learned characteristic. I was not born this way. My father, businessman, wildly risk averse. My mom, wildly risk averse. My sister, wildly risk averse. Me, way out there on the risk spectrum. And so this didn't just happen magically. I kind of started to push the edges of risk tolerance and ultimately found, and I know this just from, it's a mathematical truth, that you get paid to accept volatility. That's just true. And so if you have the staying power to withstand that volatility, then you can achieve extraordinary value. So how that ties to Michigan or this new kind of vantage point on my investment life. So I look at climate change and I say, there's a lot of markets that have been bid up that are smack dab in the middle of climate change DEFCON 1. And I find that really curious. And then I think, well,
give us an example, so
Miami.
Referencing. Okay.
Yeah, I mean, it's the southern crescent of the United States. You say the Outer Banks, but that's been that way. Any like the resort towns, but even like Miami, big cities in Florida, many large towns in the South, including New Orleans. Like in the next 50 years, maybe sooner, there's going to be catastrophe. And there's going to be trillions and trillions and trillions and trillions and trillions of dollars and lives lost. Yet if you think, okay, well, ultimately, what makes for a great place to live in a world where the planet is 1 to 2 degrees warmer on average? Access to fresh water, access to centers of academic excellence. I think, what place has those characteristics? The state of Michigan. And it's a contrary bet. But I've been investing in Detroit for a long time and have continued to amplify my investments in Detroit, particularly in the realms of affordable housing and more recently, but with similar intention, like food and beverage to help support livable, walkable neighborhoods. Exciting places for families to want to raise their kids. Working with the Department of Education to help fulfill the dream of having great public schools in Detroit and expanding access. So Now, it's not just, so I also have an unnatural love of Michigan. I was born in Detroit. My dad was a Ford guy. And then I had this incredibly transformational experience at the University of Michigan. I did not love my childhood. I came here at age 17, and it changed my life. Met my best friends, met my life partner, came into my own. So I feel a great debt to the university and partly to the state. And as a result, part of my investing of time and energy is giving back. And part of it is, I do think it's going to be smart money over time as the world realizes that it's going to be the northern tier of states, especially around academic centers and centers of commerce, that are going to be the engines of the 3-4 generations from now. And again, that say, well, how does that help me today or 5 years or 10 years from now? Given the way I think, I don't care. I'm trying to invest for a better future and invest prudently for my family.
Exciting to think about all that could be in the future, the opportunities that are to be had. And thinking about that comment you made before about that you haven't always been like this, that this is something that you kind of grew into, your way of thinking, your approach to life and business. As part of that is the authenticity piece. And I think that's a word I would always probably use when I was describing you to somebody. It's always very authentic, without question. You've written about the idea that authenticity is being comfortable when you're otherwise uncomfortable. They're embracing uncomfortable situations or circumstances. How can students best develop that as they go throughout their young careers? How can they come past the notion of feeling like they're maybe within an imposter syndrome? There's maybe half the audience who are engineering students who maybe think about themselves as they couldn't be the CEO, and they couldn't be the founder because of imposter syndrome. What's your thoughts? What's your advice to them? How did that work for you, and how did you continue to grow and evolve?
Well, first off, let me say, in terms of the notion of imposter syndrome, I still have some of that to this day. There is some measure of unreality that I'm sitting here in this context, having anything to say to a group of people like this. It is, and that's not bullshit. I actually feel that way. It's wild, but I constantly am checking myself, like, oh, this is cool. Like, this is real. But in terms of the specific question that Eric raised, the only way to get past these seemingly intractable barriers in your own psychology is through exposure and repetition. Just like, so I'm sitting up here, I went and spoke to however many people in this room, super comfortable, like literally my resting pulse and the pulse that I'm feeling when I was talking to the slides is the same. Wasn't always that way. When I was on Wall Street for the first time getting up in front of 2,000 people to talk about my business in London, when I ran equity derivative structuring and marketing at Deutsche Bank, it was fucking nerve-wracking. But there are bright lights, dressed up, super slick, 2,000 of the most senior people in the bank sitting there, and I'm just like, what am I doing here? But doing it, and of course, it was fine. But I will tell you, my heart rate was not my resting heart rate when I gave that presentation. But over time, it got better and better. When it comes to the issue of risk tolerance, again, not everybody needs to go from I'm super risk averse to all of a sudden being this crazy risk taker. It's through exposures. And I think we all need to think of ourselves as being in constant cognitive behavioral therapy mode, where we try and desensitize ourselves against those things about which we're most scared. And my wife is a PhD in clinical psychology, and I can tell you, and I've seen her do it, and even though she's not a CBT therapist, she uses them at times. Psychology was actually one of my areas of study when I was here. Desensitization and exposure is the way to overcome fear. It just is, repetition. So I think it would be super helpful for each of you to just think about what are those things you're really apprehensive about that you wish ... Well, don't wish it, do it. And guess what? I'm telling you here and now, it's going to be okay. It's going to be okay, and it'll just get better.
in addition to their own personal journeys and opportunities to go out there, create exposure, grow in that method, there's of course the formal education. What was the most valuable course you took here at U of M?
Yeah. Again, another one, given my professional achievements, that's completely counterintuitive or unexpected. Negotiation theory. Yeah. It's not some quantitative finance course, it's just literally negotiation theory, because every interaction is a negotiation. You might not think of it like that, but it is. Whether it's with your wife, your child, a friend, a potential business partner, a classmate, every interaction is a negotiation. And so to understand the framework of, firstly, understanding yourself, what do you want to get out of this interaction? It makes your mindset very intentional. And it doesn't mean artificial, it means thoughtful. And it actually helps the person or the people that you're interacting with. Because if you have clarity around what it is you want, it makes it a lot easier for them to respond as well. And so there's that piece of it, this kind of self-awareness, managing your internal state, self-psychology piece. But then there's the more commercial application, which is, let me tell you, if you understand how to negotiate well and you understand your internal state and you're able to assess the situation and price risk well, you can crush people. I mean, and leave them feeling good about it. Highly, highly, highly recommended.
That's a great opportunity to kick it out to student questions. We can kick up the lights a little bit. That'd be great. And go out. There we are.
Hey, I can see faces.
There it is.
I'm going to actually shift gears a little bit. You said you had 2 kids, and so I'm going to ask, how closely would you compare the role of being a parent with that of being a founder or investor?
Who's talking? I'm sorry. I don't.
Oh, I'm sorry. My name's Harish.
Oh.
Hello.
Okay, so how is being a parent similar or different to being an investor?
Yep.
So I would say the principles are similar in that there are expectations, shared expectations, and empathy that's required. There are feedback loops, and there's expectations of growth and lots of bumps in the road. So it's a really good question, but I actually see each of us individually as being entrepreneurs and being CEOs and founders of our lives. And in that way, I think it's all one and the same. And I think the way that I parent, I aspire to be as supportive, but also a provider of kind of constructive feedback to my founders as I do my own children.
So I heard from your talk that your wife was a great mentor to lean on, or person to lean on, as you're becoming a VC. What kind of people were your other mentors as you've grown?
Right. So yeah, the question about other mentors besides my wife as a VC. So I'm really glad you asked that, because cultivating mentors throughout your life is incredibly important. And again, one of those things, I'm not exactly how I figured it out, but I had some very good mentors both on Wall Street, and then as I went into VC, I had a handful of experienced investors who had worked with me in my days as an angel, where they had come and done follow-on rounds in companies that I had seeded, and where we cultivated this relationship. And when I was thinking about starting the firm, they were incredibly generous with their time and perspective. And then throughout my years at IA, I would check back in with them, and many of them became investors in IA. And then even later on, in certain cases, I became their mentors. So it was a really wonderful dynamic, but for sure, those people were highly influential on my path.
I guess why did you refuse to invest? What did you see in the founder that made you go, no? And how did they turn that for you wrong?
So I don't think that I have misread people. I think I've misread markets. So if I look at my anti-portfolio, it wasn't that, oh, I really didn't think this person was a good founder and they ended up being a super successful founder. It's where I looked at a company and I'm like, I don't think this has the potential to be a decabillion-dollar company. And then they end up being one. So probably my biggest anti-portfolio company is Plaid, where I knew Zach, and I saw that deal early, along with my partner Jesse, and we both kind of looked at it and said, this is like a next generation Yodlee, not that interesting. And what we didn't count on was the incredible explosion of fintech apps and nanobanks that proliferated like crazy and all needed seamless integration with customers. And so, wow, did I get that wrong? But it was not because of Zach, it was because I misread the market.
Good question. Got time for one more. Anybody that you guys have, Ern?
Yeah, so I guess talked about that a little bit, about just the notion of just having that deep passion and able to articulate the grand vision, but having enough EQ and enough introspection to be able to take constructive input from the market and from their partners. You can be coachable, but also having the courage of your convictions. So you don't want founders who are too malleable. You want them to be able to take input, but you don't want them taking your frame. So if founders are learning from me about their market, that's a problem. They should be learning from me how to speak to fellow employees, how to position their message, not knowledge of the market. So a great founder, will have almost encyclopedic knowledge of the market that they're going after. They're teaching me all the time. But where they have this insight where their view on the market is kind of orthogonal to everybody else's view, and probably the single greatest example, it's one of my very first investments at IA, is one of the best companies I ever backed, which is a company called The Trade Desk. And Jeff Green, nobody knew the domain better than Jeff, having been a co-founder of AdECN, had an unabiding belief that the world was going to be programmatic, that traditional ad buying was going to die. And he was saying this when programmatic was $3 billion and traditional advertising was $600 billion. And so it was a gutsy place to stake out a position, but we believed him, and he was right. But boy, was it hard to get there. But that to me, he's the canonical example of the visionary founder, knew exactly where he wanted to go, and nothing could dissuade him. But the missions of how to best get there changed dozens of times as he ran into technical issues early on and market acceptance issues. And it took 2 years. And I bridged him 3 times after the initial seed check. And then it caught. And it went from this to that. And so, anyway.
That's awesome. Well, that's all we have time for today. Thank you for coming by. Appreciate it.
Thanks, everybody.
They were all in your